Yeah, we start today's market talk. Market optimism amid underlying chaos. This is actually what is happening. We have observed unusual financial market volatility in recent months and instability in consensus economic narrative. From peak American exceptionalism, sentiment has swung into deep pessimism about recession and fragmentation of global order, and then back again after certain deals were done. S&P 500, VIX, and US 10-year yield have been on wild roller coaster rides and transporting the same amount of volatility to rest of the world. And the main reason is policy volatility, which is the main driver of violent swings in consensus economic narrative. Now, Nifty has reached 25,000, right? Now, what next? So, we will discuss that part. Now, what happened was that all over the world, the markets have cheered the de escalation of trade tensions, and in India in particular, the ending of the conflict. So both countries, US and China, have agreed to a 90-day reduction of tariffs, resulting in US tariffs at 30%, while Chinese tariffs at 10%. Tariff pause provided temporary relief to equity investors, but it doesn't offer businesses long-term clarity. Negotiations are expected to be complex and extend over several months, resulting in continued market volatility and uncertainty. Now, I have worked out certain scenarios that could play out in future with respect to the US markets and then for the rest of the world. First is that the base tariffs remain in place as negotiations progress. So the basic tariffs, 10, 20, whatever percent, they remain in place and negotiations go on. And what it will result in is markets show gradual cooling down. Why? Because tariffs at 10% will apply. Now, the cost will be borne by the consumers. This will lead to earnings slowdown in the US and consumer spending will reduce slowly with rise of inflation because the prices of everything will go up. And as the results will come, markets will trend slowly and slowly. Next is US China trade talks after 90 odd days conclude without agreement and markets react violently. So, markets then in that scenario will see a decline in investors' sentiment and consumer spending, and it will raise the risk of US recession and slow growth in China. So, lot of metals, all the commodities, etc., will decline because there would be a risks to the global growth, and there would be a downward trend in the markets. Now, the third scenario is Trump reinstates sector-specific tariffs. Certain market segments declined sharply, as we are seeing now. 20% tariffs on steel and aluminum imports and 100% tariffs on foreign-made films. So specific industries will get impacted, but the broader market concerns about future policy may persist because suddenly you may get a sector which will get impacted by tariffs. So markets will be sideways with high uncertainty and volatility in stock prices. The fourth scenario is significant economic slowdown with market correction. So in case nothing works out, earning growths will show sharp decline in the US and weakness will emerge in the labor and housing markets, leading to a significant market correction. Structural economic issues would arise, such as rise in consumer credit defaults, inventory imbalances run in the bond market, prompting intervention of Fed and the government. Run in the bond market means the bond yields go up, so the bonds are sold off. This is the most severe outcome and will lead to a big market correction and recession. Now, the good part or the good scenario is that trade deals go through, they get good money through tariffs, that is US, so they introduce tax cuts, potentially boosting consumer sentiment and market rally would continue. So if the US Congress does tax cuts, It may improve the consumer confidence, encourage increased spending, and lead to gains in the equity market. And the last scenario is global conflicts intensify in regions such as Middle East, Ukraine, Asia, whatever it is, causing economic strain in certain areas. Because
एक चीज कवर करना प्लीज, जो
Hanji,
what is going likelihood of the pharma companies, what because that's a little bit of
I'll cover.
gray area now at the
I'll
moment.
cover. Increased global uncertainty would be there. That will drive market volatility and move towards conservative investments, and interconnected trade flows face disruption affecting global supply chains. So these are the likely scenarios. Hence, despite recent relief rally, a cautious and diversified approach to portfolio positioning is advisable. So please diversify your portfolios. Don't be restricted to one sector only. Now, Indian markets would respond favorably to any fair deal that increases access for Indian companies to the US. Right now, the market is optimistic that the worst is behind and we will soon see more trade deals. And eliminating import duties on US goods would actually disadvantage Indian companies. And Trump indicated a possibility of a zero tariff deal with India on Thursday, which led to the rally as the trade balance currently favors India. So the market thought that if you have a zero tariff deal with the US, then as the trade balance favors India, then it will be beneficial to Indian companies who are exporting to the US. But I don't think that will be the case. What Wherever we are manufacturing and exporting to the US, the cost of manufacturing cannot be matched by the US, so tariffs don't matter. Zero tariff arrangement to labor intensive sectors like apparels, textiles, gems and jewelry, leather, plastics, chemicals, shrimp, and horticulture will boost India's competitiveness against China and other Southeast Asian nations. So one has to see all these issues. Now coming to FIDI data, this is of 16th May. So if you see here, on index futures, FIs have added shorts, and particularly most in the Nifty, little bit less in Bank Nifty, and they were long in Midcap Nifty. So it is very clear that where the profit booking is now coming to likely to take place. In stock futures also, they have added shorts. They bought in cash, but as I told you, there were few deals, or sorry, few large trades which took place. So in Bharti and in JSW Infra. So it is because of that. Pros also added shorts, and they have added shorts in index options also. Clients are net long, and they have added in index futures, they have added long positions. So they are the counterparty, and the DI is bought in cash. So that is the net flow. Right now, the FIs, as I show you here, from around 17th April, they had 83,000 short positions in index futures. It came down to net positive on 12th May. And now they have started increasing their short position. So you have to watch this data carefully, because as these short positions in index futures reduced, markets moved from 23,800 odd to 25,000. So it is directly proportional to the FI buying in cash, which they have bought continuously, except few days, roughly 50,000 crore over the last month or so, and reduction in short position. So one has to watch this data now very carefully. DIs are there to support the market, so that will continue to take place. Now coming to US, what is happening is Fed continues to hold on to cutting interest rates due to robust economic data. US labor market is strong with unemployment staying low at 4.2, wage growth is positive. Latest CPI stood at 2.3, was lower than expected. Fed is likely to wait for a sustained trend of lower inflation before considering a reduction in rates. So despite all the talk by Trump, Powell is not ready to reduce interest rates right now because they are afraid about potential increase in inflation due to tariffs, and bond markets are demanding a higher premium on US debt. So if you see here, the the US 10-year yields are going up despite even inflation coming down. People are not expecting a rate cut. So the US 10-year yield was up 1.44% uh, last week. The dollar is also strengthening and it went up. It is above this 100 odd levels. So it is also gradually going up, and that would impact all the commodities. So Brent crude is still below that 70 level and is on a declining trend line. So it is on wait and watch position. If the US deal with Iran, etc., goes through, then oil prices will generally remain at this 60, 65 odd levels. So nothing, no problem here. Gold has corrected, so money is moving out of gold now to more risky assets. So that safe haven thing is out. It has come to that rising trend line level and then bounced from there. So just watch out for this. Copper also corrected around 0.5%. It's because there is still a lot of uncertainty about global growth. Bitcoin has moved up and now it is taking a pause. So here again, there was a correction of 1 odd %. So that rally is also over now. S&P 500 was up 5.2%. US markets had a superb week, and sentiment was basically lifted due to surprise US and China trade deal, etc. So there was a big gap up on Monday, and then they have been constantly going up. So from the lows, it has really moved up above the moving 20-day moving average, or 20-week moving average, sorry, and is likely to lead higher now. Same with Nasdaq. Now it has come back. It had declined below the rising trend line. Now it has come back above it. So now it is in that rising trajectory now again. Dow was slightly subdued, but it is still above the 20-week moving average, and it was up 3.4%. So this is good. Nasdaq was also up because there is some deal in Middle East related to selling of Nvidia chips to them. So that's why it is up. Now, this is actually where you make money. So Indian government bond yields are going down. They have reached 6.2%. And as they keep going down, it is indicating that the market is expecting further rate cuts by the RBI in the next 2 or 3 sittings. And as the CPI inflation has also remained subdued, so the probability is very high now. I think RBI will next meeting would do a 25 basis point, because there is no hurry as such to support growth as such right now. So India VIX, very interesting. So it went up in April due to tariffs, then came down, then went up again to around the 22, 23 levels based on the conflict with Pakistan. And once the thing has been resolved, it has been gradually coming down. It has come down to 16 level, needs to come to these 15, 16 levels and then go below that. So that will give a fillip and lead to more short covering, etc. Because as the premiums will go down, it will reduce the volatility. Now, this is interesting. Nifty, it went up to this is the weekly chart. So it went up to the 61% retracement of the complete fall, then corrected last week, and then this week it has gone up. So in my opinion, it should touch 25,300, which should be a logical target here. And then it may consolidate and then wait for the next set of good news to go to the all-time high. The reason is that once you cross 61% retracement, then going to 100% is the most likely scenario. Hence, going to 26,000 plus is a given. When it takes place and the event which will drive the rally, it depends. But if you see here, the Nifty did around 1,000 points, opened at, it was at 24,000 or last week, and it has gone to 25,000. So 1,000-point rally in a week, 4.21%. So it's been a good rally. It has taken a lot of people by surprise, but that is how the markets behave. Now, if you see the Elliott wave, so as I see it, it's a 5-wave pattern which is building up. So if you see here from this March lows, this is A, then there was a correction to B, then if this is wave C, then it can come down to the top of wave B point, which is around 23,800 or 24,000, and then go back up to around 26,300. Because what happens is, if the market just keeps going up, then it becomes slightly overbought as such. So there would be some correction, some lower levels. It can be anything up to this level. It can turn around at 24,000, 24,300, whatever it is, and then move up. Now, hourly chart. So if you see here, this week there was a clear gap up. It went above the 20 EMA, and then the Nifty held above the 20 EMA on the hourly chart. So till the time it is above 20 EMA on the hourly charts, it remains in a bull market, and it's a long trade. For anybody who is trading this, it's a long trade till the time it is above 20 EMA on the hourly charts. Now, Nifty Bank was also up 3.28%. It had gone down. It bounced back. It is facing resistance at 56,000, where somewhere it has formed a double top. On the daily chart, again, the same thing. It did a gap up, but then after that, it has been stable at around 55,500 odd levels. So let's see where it goes. But it is above the 20 EMA. That is positive. Last week, HDFC Bank, it tested that support at 1880, and till the time it is above 1880, it remains in a bull market. So it was basically sideways. After the gap up, it has been sideways. So that is one of the reasons why Bank Nifty is not moving. Reliance continues the uptrend. So it went up from that 1,400 odd levels, and now it is testing 1,450. And if some Nifty has to be taken up, most probably it will be with Reliance only, which will drive the index up. And it is RSI is good. It has been bought with good volume, so that is also good. So stay invested in Reliance. Actual move is going to come now in mid caps and small caps. So if you see, the mid cap select was up 6%, 6.5%. And now it is, if you see, the moving averages are turning upwards, and it is clearly above the 20 EMA. So this would be the first index which will hit the previous high, in my opinion, because the earnings of if you see this quarter, the earning support has been mostly there with mid caps and small caps as compared to large caps. Small cap index again was up 9%, clearly has broken out, and it is headed higher. Let's see if it can cross this 18,000 level, then it will go higher. If you see the results for this quarter, there would be, for Nifty, the EPS growth will be slower, and there are earning downgrades have now hit a pause. So there are no earning downgrades as such. Only thing with what I have observed after going through the results of roughly more than 500 companies is that EPS growth is mostly coming due to margin improvement and not due to or you can say the margin improvement is higher than the increase in revenue. So in the final run, sustained profit growth requires robust sales expansion, which will come after corporates start doing private capex and start increasing or spending on capacity addition, etc. So till that time is there, the EPS growths will be muted, except in few sectors. Now I'll cover two stocks. Now, Blue Jet Healthcare, this is a CDMO player. Now, I'll cover this aspect also about the US tariffs in this part. Revenue growth was mainly driven by higher sales in pharmaceutical intermediates in FY25, and improved profitability was mainly due to higher sale volumes, cost optimization leading to absorption of fixed costs. Good quarter led by sharp scale up in bempedoic acid intermediate sales. Bempedoic is a chemical which is basically used for lower cholesterol medicines. The robust quarter-on-quarter uptick was largely led by scale-up of cardiovascular intermediates, which it launched in first half FY25. It commenced additional capacity in Unit 2, where it has been manufacturing validation batches for advanced contrast media intermediate, that is iodinated ABA-HCl. Now, ABA-HCl, switch off your volumes, please. ABA-HCl are basically intermediates used in production of contrast agents. So contrast agents are the ones which are basically, I'll cover about why it is used also. Basically, you expect increased contribution from commercial supplies of gadopiclinol and iodinated ABA-HCl to drive 18% contrast media sales CAGR over FY 25 to 28 on a low base. Gadopiclinol is a contrast agent given as an injection before MRI. So basically, to support the MRI actions, these are the agents which are used. Within PI, that is pharma ingredients, and APIs, that is active pharma ingredients. The bempedoic acid intermediate has witnessed robust traction after incremental capacity came on stream on third quarter. Its backward integration plans for in-house manufacturing of APD. APD is aminophenyl acetic acid, which is a KSM, that is a key starting material for making ABA-HCl, remain on track with the capacity set to go on stream by second half FY26. So it is doing backward integration. Apart from its plans to design new labs and build capabilities to develop building blocks for GLP-1 and CE. GLP-1 is basically used to treat type 2 diabetes and obesity. It plans to set up multi-purpose plant in Mahad. It has also acquired a land parcel in Dahej to expand its capacity for contrast media and PI and APIs, that is active pharma ingredients. So it has basically three parts in its business. First is contrast media intermediates. These are agents used in medical imaging to enhance the visibility of body tissues. It supplies critical starting intermediate and several advanced intermediates part of this. Second part is of the business is high intensity sweeteners. High intensity sweeteners business involves development, manufacturing, marketing of saccharin and its salts. And the third is pharma intermediates APIs. They are collaborating with innovator pharmaceutical companies and multinational generic companies, provides intermediates that serve as a pharmaceutical building blocks for APIs in chronic therapeutic areas. So these are the basically 39% or roughly 40% is of their revenues come from contrast media, 13% from high intensity sweeteners, and 45% from pharma intermediates and APIs. They have got good clients all over the world. Now coming to their this quarter's results, if you see here, the net revenues were up 85%. Year on year, and even they were good in the last third quarter of FY25 also, and they were higher than third quarter by 6.9%, but 85% year on year growth. Gross profit was up 90%. EBITDA was up 163%. Profit before tax up 171%. EPS up 177%, and EBITDA margins were up 1226 basis points, that is roughly 12%. And among their segmental revenues, contrast media was lower by 9.5%. So, and high intensity sweeteners were lower, but the pharma intermediates did very well. They were up 446%. So that part of the business is doing well. If you see the year on year, They are doing around 40% year-on-year growth for FY25. EBITDA is up 44%. Net income, that is PAT, is up 35%, and margins have improved by 116 basis points. So the point one has to see is that it's a strong growth business with growth in top line and bottom line both. And if you see here, the pharma intermediates, etc., they are having higher amount of segmental revenues as compared to the other two segments. So Blue Jet quarterly sales are on the way up. So strong year-on-year growth. So if you see here, year-on-year growth has reached nearly 70-80% now. Net revenues have been going up. Gross profits and gross margins are also going up. Gross margins are in the range of now 57-58%. EBITDA is also moving up. EBITDA growth is now reaching around 40%, and PAT growth of roughly 33%. So that's what I was mentioning. How many companies do you find where the PAT grows year on year 30%? So it's one of the unique companies which is there. Now, if you see the business mix, it's very clear. The highest mix is of pharma intermediates and APIs, and then contrast media and high intensity sweeteners. So these are the three basic segments. All are doing decently. Next year, they are expecting contrast media to do better because of higher base. Now, for future, if you see here, they are expected to grow around revenue growth of around 40% for FY26, EBITDA growth of 44%, and PAT should grow around 35%. So they are expecting with this kind of a growth over a next 2-3 years, they are expecting a EPS of around 23 or 24 rupees in FY26 and 29 rupees in FY27, taking a median of around 26. You can easily price it at 30-35 times. So this stock has been going up. So I think presently this is slightly subdued. The reason is because of the sales are to basically exports, etc., related to APIs and CDMO. Hence, they are affected by these tariffs, and because of these tariff stock, these guys are slightly subdued. Now, what will happen is it's not very clear, but I think a baseline tariffs of 10-20% will stay on all pharma companies, and that is what is keeping them subdued, because the reason is higher tariffs cannot be put because that will increase the cost of healthcare in the US. But they have huge sales and some amount of tariffs would be there. Hence, this stock is subdued despite very strong results. So, like we are seeing 26 rupees as the possible earnings, and 35-40 times. This can easily trade between with this kind of 40% growth they are having. It can easily trade from 850 to 1,000 rupees. But only thing is that because of this tariffs vulnerability, it is remaining subdued. And last few days, because of good results, it has gone up with high volumes. So it went up on Thursday after results with good volumes. It's corrected a bit. So anything, it comes to around this 750 level near its moving averages. That's the time to buy this stock for slightly longer term, because it's a good business and a growing business. And the other reason is also that it is not very well known. So it is not a crowded space as such. The other business which I'm going to talk about is Crompton Greaves Consumer Electricals. Revenue was below estimates. Robust margin improvement across categories surprised positively, helping it register a strong profit. The pumps division continues to secure healthy orders and fan sales remain steady. Residential pumps continue to maintain number one position on e-commerce. Though agri pumps witnessed subdued demand, solar pumps continue to grow. So they are now expanding into this solar pumps business. Mixer grinders and air coolers experienced strong growth supported by new product launches. They won several orders in solar pump category, order worth around 23 crores. So they're just getting into this. It is looking to set up a greenfield facility dedicated to manufacturing fans aimed at strengthening its supply chains. In lighting segment, B2C segment growth and better product mix contributed to margin expansion. Butterfly, they had acquired Butterfly. So Butterfly gained market share sequentially in mixer grinders and pressure cookers. It is looking to further expand its product portfolio by foraying into rooftop solar also. So now if you see here, the problem was that the year-on-year revenue growth was just 5%. And if you see for full year also, it was around 8%. EBITDA improved basically because they have reduced their cost. Raw material costs have come down and operating expenses, etc., have also come down. Hence, they have been able to improve their margins from 10% to 12.5, 12.8, and that has helped in PBT going up 37% and reported net profit going up 29%. So this is the basic issue. EPS has gone up around 28%. If you see full year revenue, if you see here, revenue was up 8%. EBITDA margins have been up and profit is up around 28%. From $7, it has become 9 rupees. Now they have basically three segments. The smallest or the largest is electrical consumer durables called ECD, and the other two smaller ones are lighting and Butterfly. So electrical consumer durables largest was around 6%. Butterfly is growing to around 11% now, and lighting is slightly subdued. So we'll have to see what happens. So it is this electrical consumer durables where pumps, etc., where there is likely to be growth, and Butterfly. So the EBITDA margins of Butterfly improved. So if you see year on year also, electrical consumer durables grew 11%, and EBIT margins of all three segments have improved year on year also. So this is basically a margin improvement play. The top line is not growing that much. So right till that, because of basically consumer demand is subdued. So let's see what happens as if the consumer demand picks up. If you see 5.1% year-on-year growth in revenue, operating profit increases 30%, margin expanded by 240 basis points to 12.8, and PAT grew by 29%. So let's see their growth. Growth is expected to be revenue growth around 10, 11 to 16% in future. PAT growth is supposed to be higher, 17 to 26%. So it is expected to do around 10 rupees in FY26 EPS and 12.9 or 13 rupees, 30% growth in FY27, but that is slightly far off. So 11, 12 rupees, this can easily trade at around 40 times. So around 400, 440 should be the good value because it's a sustainable business, long-term business. PE is still low because of it's a business in transition. ROE, etc. are improving. EBITDA margin is improving. So now if you see here, Crompton Greaves Consumer, it was on a declining trend line all over from last year September, where it made a high at around 480. And then there was a declining trend line. And now on Friday, with large volumes, it has broken out. So let's see if this can sustain. There is some value here, but it is not that screaming buy also. So somewhere closer to this 320, 330, this can be bought if you have a long-term horizon. And this is a safe business to buy because nothing much can go wrong from here, and valuation comfort are there. 10, 11 rupees at 30 times right now at the present price. This is not very expensive. I've finished. We'll take questions now.